If I told you that small business lending across 50 countries was down 20% compared to 2019, you would probably blame the obvious villains, like high interest rates, inflation, or maybe a tightening credit market. But you would actually be wrong. Welcome to the deep dive.
Yeah, it is definitely not what people expect when they look at those numbers.
Right. So today we are taking a stack of research from the latest OECD report on small business finance. And our mission is to break down this massive shift. We want to explain why the biggest pressure on entrepreneurs, and really the global economy, is something you cannot even see on a balance sheet.
It is completely invisible. The OECD data highlights this quiet killer of capital expenditure, and it is not the cost of money. It is simply just uncertainty.
Wait, I have to push back on that premise right away. 20% lower lending compared to pre-2019 levels. We just went through a massive global inflation spike where literally everything costs more.
Right, everything is way more expensive.
Yeah, so logically, shouldn't businesses be borrowing more capital just to keep up with their basic operating costs?
You would definitely think so. But the data reveals this fascinating economic mechanism at play here. When the OECD studied these 50 different economies, they found that the main issue choking off the flow of capital is not actually high loan rejection rates.
Oh, really?
Yeah.
So banks are still lending?
Yeah, banks are still totally willing to lend. The drop comes from a phenomenon that economists call the discouraged borrower.
Okay, let us unpack this. So it's like not even applying for a promotion because you assume the paperwork is a nightmare and they will just say no anyway.
That is a great way to put it, yes.
So these business owners look at the landscape and just self-select out of the market. They skip applying because they assume the process will take too long, cost too much, or just fail.
Exactly. They do not even bother. And it is crucial to understand why they do this. It is not just some general pessimism. Uncertainty acts as a massive shadow tax on a business.
Shadow tax, wow.
Yeah, because if you do not know what tax rates or supply chain tariffs or compliance costs will look like 12 months from now, you have to factor a huge risk premium into your budget.
Which suddenly turns a highly profitable expansion plan into a massive money loser on paper. It is like trying to play a game of chess, but someone keeps changing the size of the board every 3 minutes.
Right, you cannot plan 3 moves ahead.
Exactly. You can't plan, so you just stop moving your pieces altogether.
That chess analogy captures the mechanism perfectly. If a business owner cannot accurately forecast their return on investment, the only rational decision is to freeze.
Because doing nothing is safer than guessing wrong.
Precisely. Let us say a mid-sized manufacturer wants to upgrade their assembly line, but there are pending shifts in trade policies that might, double the cost of the raw materials they need.
Oh man, yeah, that would be terrifying.
It is. They are not going to pull a multi-million-dollar loan to buy new machinery until those rules are set in stone. That is why overall SME lending volumes are still about 20% lower.
Here's where it gets really interesting though, because it is one thing for a single factory owner to hold off on a loan. But how does one hesitant owner scale up to a 20% drop in overall lending globally?
Well, because that hesitation operates like a contagion. When financing rules and economic policies are constantly shifting, a firm decision to say yes to growth turns into a maybe later.
And in the business world, maybe later usually means never.
Absolutely. Multiply that single unbought factory machine or that one unopened second storefront by millions of small and medium enterprises. If we connect this to the bigger picture, small businesses are what actually power national growth.
Right, they hire the contractors, they buy the software, they lease the real estate.
Exactly. When capital becomes uncertain, the entire economic engine hesitates, and innovation just grinds to a halt.
So what does this all mean for the listener? Are these businesses just asking for cheaper money or some kind of special treatment?
No, not at all. They simply want predictability. They need stable policies and clear lending rules. So planning for next year is not a gamble. They are not holding out for 0% interest rates.
They just need to know what the rules of the game are going to be next year. So planning a budget doesn't feel like spinning a roulette wheel.
Yes, exactly.
It completely reframes how you look at market dynamics. The next time you see a headline about central banks adjusting rates, remember that the actual cost of money might be secondary. For the people actually driving the economy, certainty might actually be the most valuable capital of all.
It really is. And it leaves you with a rather unsettling question to think about. If a simple lack of predictability has quietly suppressed 20% of small business lending, what other critical sectors of our society are secretly shrinking right now simply because the rules of the game keep changing?